In this video, I'm going to explain the secret advantage that small investors have over larger investors that almost nobody is taking advantage of, which, if taken advantage of, can mean very high market-beating returns. Now, please take a sec to give this video a thumbs up because it really helps out, and let's get into it. Actively managed funds, on average, can't beat stock market index funds. This is pretty much an accepted fact at this point. And this is one of the reasons why the strategy of just investing in index funds with the lowest expense ratio possible and doing so consistently over time without trying to time the market has become such a popular strategy for investing. The idea behind it is people have said, well, look, if professionals and experts can't beat the market, then how can you and I expect to? But then there's the question of why does Warren Buffett keep saying that it's a huge structural advantage to not have a lot of money? And then even says that if he was working with under $1 million, that he guarantees he could earn 50% a year on it. 50% a year, by the way, is absolutely nuts. That would turn $10,000 into $1 million in less than 12 years. So to answer why it is that investors with smaller sums of money can earn much higher returns than the big multi-billion-dollar funds out there can, I'll explain it by explaining the problem that Warren Buffett is referring to and the problem that he's faced with when it comes to investing. As of their last quarterly report, Warren Buffett's company, Berkshire Hathaway, had around $140 billion of cash just waiting to be invested. Now let's say for some reason that hypothetically he had no choice but to invest all of it right now. So if hypothetically he had to divide up that money over 50 different stocks, it would mean that he would be purchasing about $2.8 billion worth of shares in each of the 50 stocks. Or if he had to divide that money over 100 different stocks, it would mean about $1.4 billion into each of those stocks. Okay, so keep that in mind and now check this out. There are about 6,500 public companies in the United States listed on the major exchanges. And from that list, as of today, just 669 of those companies have a market cap of over $10 billion. And approximately 2,300 of those companies have a market cap over $1 billion. Now for Buffett and Berkshire Hathaway, even if they bought just 10% of one of these $10 billion market cap companies, that would still be only $1 billion of the $140 billion of cash that they're looking to invest. There's only 79 companies with market caps over $100 billion. Warren Buffett is faced with the exact same problem that the rest of the fund managers of the world are faced with. Their universe of investable stocks is small, all of the stocks within that universe are widely followed and therefore much more competitive, and buying large amounts of shares without affecting the share price is very difficult. For Warren Buffett, the bottom line is that to invest all $140 billion immediately, he would need to spread it out across at least 50 stocks or probably more. However, the problem with that is that there just isn't that many good investment opportunities within the pool of companies that they can even consider. It's not the worst problem in the world that one could have, of course. However, with that said, why would we as small investors unnecessarily put ourselves into that same boat that the large investors are forced to be in? The answer is we probably shouldn't. One piece of investing advice that comes from Warren Buffett and his business partner Charlie Munger very often is that it's going to be easier to catch fish when you're fishing in a less crowded pond. The universe of stocks that is made up of these large market cap stocks is a very crowded pond to be fishing in. Expanding our horizons to those companies that are smaller, which the big money managers can't even consider, is a good place to find good opportunities. Now, having said that, occasionally the largest and best companies of the world will become mispriced lower than their worth and therefore become great investment opportunities. This is definitely true and does happen from time to time, and it will usually happen because some bad but temporary news that has come out, or because the stock market as a whole is experiencing a sell-off. Small investors like you and I should absolutely continue to keep an eye on these larger companies because a lot of these larger companies are practically monopolies, so owning them at a good price would be amazing. However, what I am saying here is that you shouldn't be limiting yourself to just only these largest companies in the same way the billion-dollar money managers are forced to. And the reason is simply because more often than not, these companies are going to be overpriced. Here's the next major takeaway from all this. These large investors are basically forced to be highly diversified. Smaller investors like you and I have the ability to concentrate our investments if we want to. Now, when it comes to Berkshire Hathaway, they're unique because they're okay with holding onto cash and just waiting for the market to sell off or for a juicy opportunity to become available. They're okay with even waiting around for years for the opportunities to come. However, the pension funds and other actively managed funds out there that are attempting to beat the market are typically fully invested, meaning they don't usually have cash lying around waiting for a good opportunity. So they're usually fully invested, and if these fund managers wanted to put all the money they manage into their 2 or 3 best ideas, they really couldn't. And this is because of all the reasons I just mentioned. Their universe of investable stocks is small, and buying large amounts of shares without affecting the share price is very difficult. So when that fund manager picks their 50th favorite investment, they're not doing so because they think it's just as good as their #1 favorite. They're doing so because of the limitations imposed on them due to the amount of money that they're managing. These are the limitations that are not imposed on us smaller investors. If we wanted to, we could put all of our money into our 2 or 3 best ideas. And this is actually one of the reasons why the most successful investment funds quickly stop being so successful once they become more popular and their assets under management begin to grow as new investors contribute to the fund. Typically, the money manager is no longer able to use the same strategies that earn the higher returns in the first place. So there we already have two major advantages that small investors have, which are one, that we're not forced to consider only the largest companies, and two, we're not forced to diversify our money across 50 to 100 different stocks. And by the way, if you're benefiting from this video at all, please give this video a thumbs up because it really does help out the channel. So please hit that like button real quick right now. Now, diversification is great if you don't want to put a lot of time and effort into researching stocks. There's a trade-off. The more diversified you are, the more average your results will be, but the more you'll be protected from embarrassing yourself. If you're okay with putting in the work required to be a value investor and researching companies, then just owning a small handful of stocks of your best ideas is a pretty easy way to do better than the market average just in and of itself. Warren Buffett did 50% a year in his early years, and another famous value investor that I've learned a lot from, Joel Greenblatt, also did 50% a year in his early years. Now, he started with $7 million in his Gotham fund in 1985 and produced annualized returns of 50% a year by investing in special situations like spin-offs and other corporate restructurings. In January 1995, Gotham returned all capital of outside partners, approximately $500 million, and closed its doors to new investors. Spin-offs are interesting. A spin-off happens when a company takes one of their subsidiaries, or in other words, a particular business unit within the company, and separates it by creating an independent company for it. Most often the way it works is that shares of this newly created company are distributed to the original company's shareholders, almost like a dividend. Instead of it being cash distributed to the shareholders, it's shares of this newly spun off company that are distributed. Various studies have shown that investing in either the spin-off company or the parent company that did the spin-off on average tend to outperform the market, at least in the first handful of years after the spin-off. So that's pretty cool on its own. And the other thing that makes spin-offs attractive to me is that the act of a company doing a spin-off is usually a good sign that the management is very focused on maximizing shareholder value, and this is definitely a nice bonus for us investors. Also, shares of spin-offs can often be purchased at nice low bargain prices shortly after they've been distributed and begin trading. And here's why that is. The spun-off shares are often very quickly sold off by their owners once they've been distributed to them, which subsequently causes the share price for them to go down and therefore creates that opportunity for you and I to buy them at bargain prices. The reason they're often quickly sold off is just mostly due to shareholders not wanting to take the time to figure out what this new company that has been spun off to them is worth. Or maybe just because their original investment thesis was based on the parent company's business and not the business that was spun off to them. So the easiest thing for them to do is just to sell it right away once it's been distributed to them. But like I said, this indiscriminate selling can often cause the share price of these stocks to become nicely underpriced relative to their intrinsic value and therefore potentially great investment opportunities for you and I. Now, of course, I wouldn't suggest blindly investing in spin-off companies or the parent companies of spin-offs just because they're statistically likely to outperform the market. However, I am just pointing out that it can be a great pond to fish in when looking for investment opportunities because it is an area that's very often overlooked. Spin-offs are usually smaller in size and therefore not on the big money manager's radar. Now, before you buy a spin-off or the parent company of a spin-off, you're going to want to do some research. This website here, stockspinoffinvesting.com, has a list of upcoming spin-offs, and each one has a link to a resource page where you'll be able to access some great information and a link to the spin-off prospectus document. And reading through this will help you determine what the company is worth and whether you want to invest. Now, if you want to dive into this subject even more, one of my favorite investors and authors, Joel Greenblatt, wrote this book, You Can Be a Stock Market Genius. And in this book, he covers some of what we've covered in this video already, with stories and examples included. And he also includes a handful of other secret hiding places that value investors can find nice opportunities. At the end of the day, for me personally, while I will for sure be open to looking at these special situations for potential investment opportunities, and I do strongly believe it's worthwhile to understand how they work, my bread and butter will still be focused on buying great businesses at bargain prices and then holding on to those shares pretty much indefinitely so that I can benefit from the power of compounding, and then of course running a concentrated portfolio. Currently, 90% of my net worth is in just 3 stocks. Just the fact that we as small investors are not limited to only the largest market cap stocks and that we're not forced to diversify across 50 to 100 different stocks is the main advantage that I will be capitalizing on to create my market beating returns that I'm going for. I'm going to be creating a video soon going into a lot of detail on diversification and things like building a portfolio, so please subscribe if you're not already and you'd like to see that when it comes out, and please hit the thumbs up button below. It does really help out. Before we end this video, I want to leave you with a clip of Warren Buffett and Charlie Munger talking about the subject of big returns for small investors from their 1999 shareholder meeting when someone asked them how can they achieve 50% 10% returns that they keep talking about. First though, a quick reminder, I'm not a financial advisor, so please don't take my content as financial advice. It's not advice. I'm just someone who loves business and loves investing and has spent a lot of time researching and learning about it. Please enjoy my videos as entertainment and go seek out a local qualified professional if you feel the need to. All right, now check out some advice from the legendary Warren Buffett and Charlie Munger.
I think working with a very small sum, that there is an opportunity to earn very high returns, but that advantage disappears very rapidly as the money compounds. Because from $1 million to 10 million, I would say it would fall off dramatically. You find very, very small things that you can make, and you're almost certain to make high returns on, but you don't find very big things in that category today. I'll leave to you the fun of finding them yourselves. I mean, it'd be terrible to spoil the treasure hunt. And the truth is, I don't look for them anymore. Every now and then, I'll stumble into something just by accident. But I'm not in the business of looking for that. I'm looking for things that Berkshire can put its money in, and that rules out all of that sort of thing. Charlie?
Well, I would agree, but I would also say that what we did 40 or so years ago was, in some respects, more simple than what you're going to have to do. We had it very easy compared to you. It can still be done, but it's harder now. You have to know more. I mean, just sifting through the manuals until you find something that's selling at 2 times earnings, that won't work for you.
It'll work, it's just you won't find any.
Yeah.